Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at VST, or Vistra Energy Corp. VST is a Fortune 500 integrated retail electricity and power generation company based in Irving, Texas. Here's the barchart.com technical opinion rating for VST. The bar chart rating is a 100% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, stock is in a bull trend on a monthly basis if the stock price is above the 10-month or 10-period simple moving average. The monthly chart shows that VST is well above the moving average line, so the monthly trend in VST is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in VST is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. VST stock price is below the upper Keltner channel line, so VST is inside the buy zone. Since the trend is up, we want to buy a call. Vistra has plenty of option chains to choose from. We're going to use the December 20 option chain. Right now, the December 20 options have 19 days to expiration. Here's part of the VST option chain for December 20. VST closed at 159.84 on Friday. That means any calls on the list from 130 to 157.5 are in the money. Let's take a look at the profit potential for purchasing the 160 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 160 call is 870 to 950. We try to enter at the midpoint, so we'll use 910 as the buy price. Our call option calculator shows the profit potential for this call based on VST price changes at option expiration from flat to a 12.5% increase in price. We can see that if the VST stock price is flat at 159.84 at option expiration, the 160 call will lose 100% of its value. Ouch. This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule is to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now we're going to take a look at buying the 145 strike call to see if it qualifies for the 1% rule. Here is the call option calculator picture for the 145 strike call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the VST stock price is up 1%, the 145 call will lose 6.6% of its value. We want that to be break even or better, so the 145 call does not work. Let's see if the 130 call will work. The bid-ask spread for the 130 call is 30.10 to 31.80. We try to enter at the midpoint, so we'll use 30.95 as the buy price. The 130 call works. If the VST stock price is up 1%, the 130 call will make a 1.6% or $49 profit. That's better than break even, so the 130 call is the one we'll buy. The call option purchase calculator also shows that if the VST stock price increases by 2.5%, the 130 call will make a 9.3% or $289 profit. If the VST stock price increases by 5%, the 130 call will make a, 22.2% or $688 profit. If the VST stock price increases by 7.5%, the 130 call will make a 35.1% or $1,088 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the VST stock price does not make the expected move up and remains flat at expiration, the 130 call would only lose minus 3.6% or minus $111 compared to the minus 100% or minus $910 loss for the 130 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the VST December 20 140 strike call and sell to open the December 150 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 140 call for $21.60 and sell the 150 call for $14.60. $21.60 minus $14.60 equals $700 even. So the entry price or debit cost for the spread is $700. The call option spread analysis calculator picture shows that the spread will make a 42.9% or $300 profit if the VST stock price declines by 5%, remains flat, or increases in price when the options expire. If VST is down 7.5% at expiration, the trade will make 12.2% or $85. Creating the debit spread will allow us to collect a $1,460 cash credit to our brokerage account for the sale of the 150 call. As we said on the previous slide, this reduces the cost of entering spread to $700. Here's the note regarding earnings reports. The next VST earnings report is scheduled for February 6th. Let's review the trades one more time. The first trade was a call purchase, said to buy to open the VST December 20 expiration 130 call for $30.95. We also reviewed the spread. The spread said to buy to open the VST December 20 140 strike call and sell to open the VST December 20 150 strike call at a debit of $700. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.